Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Wow. I really like that new intro. That's pretty cool. Anyway, as the man said, this is Bill Bullington. Here every Saturday morning from 11 to noon, 1420. Feel free to call in, 216-901-0945 if you have any questions. I'll start off talking about the upcoming seminar, which is actually this Thursday. It's going to start at 6:30. That's at the Corporate College East. That's the, if you want to go to the website, bullingtoncapital.com, you can sign up there. Got about a little over 30 seats remaining, and should be a lot of fun. We're going to be talking about a new tool that we're using. It is, you can do a retirement plan. In fact, anybody that comes there, I'll set up a retirement plan for you and let you see how you do it. Not very difficult. That's one of the things I think is kind of, it holds people back a little bit. They look at how difficult so many people in our industry make this seem to be, and then they don't do it. They get frustrated, and they stop. It's really not that hard. In fact, if you know which questions you need to ask, it's really, if it takes you more than 10 minutes, it's because you're new. And so don't let people confuse you. It's not that hard. We're also going to take a look at a relatively simple, this is super simple, by the way. Super simple technique to help you identify stocks that may be potentially undervalued. If they're undervalued, that's what we want, right? And actually, if you buy a good company and you don't overpay for it, you can make money with that too. If you buy stocks that are undervalued, at some point in time, that value gets recognized, and hopefully soon, and that's how you make money. So these techniques are really simple. I'm actually going to give out a little tiny paper that's going to be an e-booklet. It's not even an e-book. An e-booklet. I'm not sure if that's a word. Is that a word? But maybe we should ask Donald Trump if that's a word. And I'm just kidding. By the way, did you see where he cut a deal with the Democrats to get that's pretty amazing. That's absolutely amazing. So I thought that's pretty cool. I'm sure it made a lot of people mad over that. Of course, the president is a lot like a quarterback of a football team. Without an offensive line and a good defense, you ain't going anywhere. You're going to do nothing, especially without an offensive line. So you got to have the supporting cast in there, and they take too much blame. Quarterbacks always take too much blame, and they get too much credit. They're one player on a team. Same thing with the president. Same exact thing. I'm going to leave that alone. I really politics actually bore me. I studied enough about it to know that you're not going to know too much, no matter how much you study. So we're going to stay away from that. Anyway, so we got the seminar coming up. It's on Thursday night, 6:30, Corporate College East. So I always have a lot of fun. I'm assuming other people are having fun. There is no cost to attend. Seating is limited. I'm going to have you guys read for me a little booklet. It's an e-booklet I'm trying to get put together. And that's going to be free as well. Well, actually, there's a catch with that one. You actually have to read it and give me some feedback on it. I want to make sure that people are kind of understanding. This is important stuff, and it's not that complicated. It really isn't. And I guess you can make it as complicated as you'd like it to be, and people have done a phenomenal job in my industry of making everything extremely complicated. It doesn't really need to be that way. But if you like it, if you're one of those people that likes things really complicated, then you love the financial services industry. You should probably go work there. Keep people like me employed, breaking it down into English. So anyway, if you have a phone call, question, or comment, you can always call us 216-901-0945, 216-901-0945. If you wanted to meet with me, you can do that too. You can go to my website. Just fill out the contact us form. We're willing to do that. Ready to do that. Don't worry about anybody calling and nagging you, because we have a hard enough time calling back the people that want to talk to us. But it is always fun. Got a lot of really, really nice clients. And I think when you're looking at what's going on in the economy, when you look at valuations on stocks, this is a pretty good place. We're in a pretty good place. A lot of people are looking at the headlines and the Irma surge holds big risk. And let's talk about that for a second. I'm hearing that there's no flood insurance in these areas because they never had a flood before. Now, I don't know if that's true or not. I'm just repeating what somebody told me. So even if it's not true, even if it is true, do you remember what happened every other major hurricane that we've had? Remember when Florida got 3 major hurricanes back to back, 3 years in a row? 3 years in a row? I remember because I owned a little insurance company that after the first 2 years, this was hilarious. The company got beat up because they had to pay out a lot of claims and whatnot. Stock prices down really, really low. I buy this stock. I didn't put a ton of dough in it. I would never do that, especially on a speculative company that's relatively small. And not a ton of dough for me at that point in time was 5% of my portfolio, which for the average mutual fund manager goes, oh my God, that guy's crazy insane. That's super aggressive. Well, I didn't think it was all that aggressive. And lo and behold, all the insurance companies had raised their premiums up dramatically in the state of Florida after that second hurricane came through. Dramatically. The third hurricane, which had never happened ever since they started tracking the weather, 150 years ago, something like that. Third hurricane comes through. Well, this little company had decided not to raise their premiums after the second one because the chances of another hurricane coming through. So I lost my 5%. That's the bottom line. And I thought, wow, it was amazing. So anyway, they didn't raise premiums, and then another hurricane came. They had to pay out those claims, and actually they had to sell their insurance holdings. Somebody else came and paid those claims off, by the way. Another insurance company bought them out. And see, that's kind of what happens when you've got these types of problems, when you've got like financial institutions that go down. This is what the argument that I was being presented with. And I know the person that gave it to me is probably listening to this and going, "You rat! I'm not gonna call you out. I'm not gonna use your name. I would never do that." And but I was very upset. Oh, these mortgages, they're gonna. Let me tell you something. They have built into the model a self-healing process, and they'll use it again if they need to. I think about this. What was a bigger financial disaster? The 2007 through 2009 or hurricane? I promise you, 2007 through 2009 was multiples of the problem that this is. So we'll get through it. We'll handle it too. That's very interesting, though. I think I've been trying to find some companies I thought might benefit from the breach at Equifax, the credit reporting company. A lot of the data that they got hacked. And I've got a couple names there, but I don't want to talk about them yet. Maybe I'll talk about them at the seminar, because by that time I'll have research finally done on that. But I think there's probably opportunities in that for companies that are involved in software that would help prevent, somebody opening up an account. And by the way, one of the things that we're talking about, that 10-minute retirement plan, is using a software package that I make available to all my clients. And it has a retirement planning tool in it. And if it takes you longer, like I said, if it takes you longer than 10 minutes, then it's because you're new. It's really not that difficult. And it's pretty comprehensive. It is comprehensive, not pretty comprehensive. It covers the whole thing, everything you need to know. Listen, everything you need to know. Not everything you could possibly know. That's what the financial services industry does. They throw an entire book at you with thousands of definitions. Oh, you need to know all this. No, you don't. Yeah, this has everything that you absolutely need to know. And it's kind of funny. There's a big difference between what you can know and what you need to know. We're going to focus just on those things that you need to know. And like I said, once you've got the data, it's not very elaborate. Don't you hate when you go through you go through those financial planning questionnaires? They ask about everything possible. Some of them are even as like, well, we need to look at the deed on your property. Yeah, really? I don't think so. Yeah, and it really. Anyway, we're not like that. We need to know the important things, and that's what I've always said is you got to know what you can know. You have to know what you can't possibly know, and you have to know the difference. And that's the tricky part. You got to know the difference. Anything that's important that you need to know, you better get it. When you're looking at a company to invest in, there are some things that you need to know. And that's actually the second part of that seminar is we're going to look at those things. There are certain things you need to know. There are a lot of things that you can't possibly know. You can't possibly know the answers. And let me give you an example. Hershey's has no idea just how many pieces of chocolate it's going to sell over the next 3 months. They don't have any idea. They have an idea of how much they could actually produce over the next 3 months. They know what the capacity of all their suppliers or in their factories are. They know what that is. They don't know that they'll sell enough to be able to produce that much. They may actually be running short at some point in time. If some of their facilities or some of their distributors or some of their supporting businesses are in the hurricane area, guess what? They might not meet their goals for that quarter. And those are all the types of things that you just can't know the answer to. And that's where I find most people get hung up in the stock market is they try to find answers that you can't, there's no good answer to. But they insist on trying to know the unknowable. And that'll be incredibly frustrating for you. Incredibly frustrating. In looking at a past performance of a fund, that's meaningless. It really doesn't mean much by itself. There are other things that you need to know, and we're going to talk about those things too a little bit at the workshop. We've got the Department of Labor model now that they forced us all into doing, and now it looks like they're not going to enforce that rule. It was a good thing to do, though. I really do. I believe that it's a good thing to do, and actually gave me a couple of ideas that I'm working on for the seminar after this one. And so I'm like way in advance. I kind of like things like that. Let's work out into the future. And having said that, my mind is just bouncing around a million different directions today. Sorry about that. But having a goal, having an idea of where you'd like to be one day when you get ready to retire. What kind of income would you like to have? Because that's going to determine what your lifestyle is. And the vast majority of people, by the way, could get by without making any changes at all on about 85% of their current income. The vast majority of people could do that. Why? Because you're not paying Social Security or Medicare anymore. That's 7.5%. Okay, and we're assuming that you're saving something and should be at least 10% of your income, minimally 10%. Okay, so if you take 7.5% plus 10%, okay, that's 17.5%. So if you're at 85% of your income, you're actually slightly ahead in retirement than you were when you were working. How cool is that? Okay, so then the next thing you want to do is take the amount of income you might get from Social Security or a pension and subtract that out from that number. You can go online and get an estimate there. It's pretty easy. Actually, our software will actually do it for you. And so you subtract that. Then you take that balance, whatever that number is, and multiply it by 20. Because if you're going to take out 5% a year, which is not risk-free, by the way, but if you're going to take out, I'm just using the numbers because it's easy. If you're taking out 5% a year, it's the same thing as saying, okay, 5% of something is the same thing as 20 times that number. Mathematically, they are the same. Don't run off the road trying to do that calculation and prove it right now. Wait till I get home. take a calculator, divide a number by 0.05, and then take that same number and multiply it by 20. You're going to get the same answer. In other words, 5% of something is saying you need 20 times that amount to pull out 5%. And that's important. So whatever rate you're going to use in retirement, I would suggest sticking between 4 and 6%. It would not go above 6. And to go well below 4, you could if you have enough money. But somewhere between 4 and 6%. So just use 5. And 20 times whatever that number is. 20 times 85% of your income, but minus the Social Security you're going to get, because that's going to make a big difference. That's going to make a huge difference. If you have a pension, it's going to make a huge difference. If you don't use those numbers, it's going to be depressing. I mean, think about that for a second. Let's say you and your wife, you work together, you bring in $100,000. Okay, so 85% of 100 is $85,000. 20 times 85,000 is 1.7 million. That could be depressing. Can you see how that could be depressing? I just reminded myself of somebody I know, their tone of voice. That was I borrowed that actually. That's hilarious. I did that. I didn't mean to do that, but anyway, they're having an impact on me. But that's basically how you do the retirement plan. And if you're not getting this, that's okay. That's why we're doing the workshop, because there's a piece of software out there. We've got software that allows you, and incidentally, because of the breach, this software, not only does it have the coolest retirement planning module in the world as far as I'm concerned, because I've seen nearly every single one of them, and I've worked with a lot of them. This one's simpler, it's easier, and it's comprehensive. Like I said, after the workshop, you should be able to do this yourself in less than 10 minutes, no sweat. And if you can't, it's because you got bored and fell asleep during the workshop. I'm going to try to prevent that from happening, by the way. But I just lost my whole train of thought there. That is hilarious. We got about, a little over a minute before we go to commercial break. And if you want to call and ask questions regarding this stuff, that's great. 216-901-0945, 216-901-0945. And again, with these retirement plans, people are making this way too complicated. Doesn't need to be that way. When we come back, we'll review that a little bit more, and then we'll talk a little bit more about identifying individual stocks that may be undervalued. Stay tuned. This is Bill Bullington right here on 1420 The Answer. I'll be right back. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. And we're also available as a podcast on 955 The Fish. And I think it's 955thefish.com. I'll have to double check that, but I'm pretty sure it is. And you can also download it if you miss it. Go to Apple iTunes or go to my website, and you can download it from there as well. And if you miss something, you can always send me questions. It's bill@bullingtoncapital.com, or you can just go to my website, which is Bullington Capital, and hit the Contact Us form, send in a question. I'd be glad to address any of your concerns on the radio during a show. And you can always call us live with questions, 216-901-0945, 216-901-0945. And I'll tell you again, we got a few seats left at the Thursday night seminar. It's going to be at the Corporate College East. That's at my website as well. You can sign up for that by going to Bullington Capital, clicking on the seminar link, and it'll take you right there. We're going to be talking about a 10-minute retirement plan. And again, if it takes you longer than that, it's because you're new, or you're one of those people I like to call a complicator. And there's nothing wrong with that, and it's not a derogatory thing. Some people need that. Psychologically, they need that. It's like a compulsion. And that's okay. We all have compulsions. You may get a little frustrated when I show you how easy this is, but that's okay. And I'll show you how to make it really complicated if you'd like to. Okay, just to make you happy. But if you'd really like to get something that's simple, that you can get your arms around, you can go in and with this tool that we're providing. This is one of the services that at Bullington Capital we give everybody that it's got access. And if you haven't heard me talk about it, if you don't have it, it's because you haven't called in to ask for it, because this has really been the only way that we've been marketing this, is to talk about it on the radio. So people they listen, they ask for it, and then we set it up for them. It allows you to go in to track your investments. Now, eventually, by the way, we'll get it rolled out to everybody, but it's pretty tough because there's a lot of interaction that goes on. So if you call in, we'll set it up immediately. If you're listening to the show, if not, we're going to get around to it anyway, because I think it's very important that you're able to see everything on one page, and it's one login. This site is super secure. You can't do transactions on it. All you can do is read. It's read-only data, which means nobody can go in. If they were to hack your account, it wouldn't matter because they're not enabled to make transactions anyway. And one of the things that's very important about this service is I set up an alert. So anytime something goes through on one of my accounts that's over $100, okay, over $100, I get an email. And it emails me, it tells me what it was, and I can click on that link. It takes me right back to my personal website, shows me what it was. And if I don't remember it, or if it looks unusual, I just call the institution immediately and ask them. And so far, I've only done that a few times, and each time it's been something that I forgot that I did myself. But to have that kind of a service, I think, is a really good idea. The other thing is that there's a digital vault there, and you have unlimited capacity. Now, I haven't had a lot of people using this yet. The reason that we're using it is so that if you want help to upload a document like a trust or a deed to a property or a durable healthcare power of attorney, we can put those things up there. If you got in trouble, needed a copy of that right away, we can get it to you. Or you can go in and download it yourself. You don't need us for that. And you can add anything else that you want, and you don't have to show it to anybody but you. You can keep it personal. The settings are in there in the software. So this is a really nice tool. It's kind of a departure from a lot of the stuff that we've done in the past, in that it's a lot more personal. But I think it's a really good time to be doing stuff like this, because one of the keys to keeping your stuff safe is being able to keep a good eye on it. And with this, you can add any other accounts in addition to the ones that we manage, okay, to that site, and you can see everything in one place. And I think it's a really good idea that people do that. I think it's a good idea that they add the value of their real estate. Maybe they've got some collectibles if they've got a reasonable estimate on. You can upload your insurance policies. I mean, think about that for a second. These guys are going through those floods in all over the country. Well, southwest part of the country. And if their insurance policy is in the house that's got 6 feet of water in it, it may be a little difficult to read. But if it were stored safely and securely on a site, you just go click, click, download and print. And if you don't have a printer, we'll download it and print it for you. We'll print it for you, because you can give us the ability to do that if you'd like to. And I just think that's a great idea. It's an organizer. One of the keys to anything, I don't care what you're doing, you got to have a plan. Doesn't need to be super elaborate. It just needs to be highly effective. That's what we're looking for. Highly effective plan. And this is one of the tools that this service has that we're now offering through our firm. And I just think it's a great idea. And it's really not that hard. I know everybody's going, oh, yeah, I don't want to learn the technology. Well, you don't have to. We'll put it in there for you. I'll show you how to access it. That's all you need to know how to do is access it. You let us know what you want in there. We'll get it in there. And then you can access it anytime you want. And if you are like techno savvy, awesome. Because there are a whole bunch of tools that I'm not going to talk about. Because I would never get done talking about all those tools. And they're good, and they're available. So, again, and we're going to be using that at this workshop on Thursday night. I'm going to show you the retirement planning tool. If you didn't know where that was, by the way, it would probably take you a very long time to locate it. And that's what's good about having concierge-type service, where you call in, and either myself or Melissa or Gary, the other guys that work there, Brad Loheiser, those guys can come in and say, oh, yeah, go here, here, here. And by the way, if you can't do it, they can actually do a web meeting right there on the spot and show you. So it's pretty cool. I'm really excited about it. It's just going to make the job that we do a lot easier to do. And I think that's a key today. Everybody is starved for time, which is amazing. I mean, think about that. How much easier are our lives? I mean, they're more comfortable, but how much less time do we have than people had a long time ago? I don't know. Maybe I'm just imagining that, but it just seems as though people are extremely busy today. And incidentally, I keep forgetting. If you'd like to call in today, the number is 216-901-0945, 216-901-0945. And again, if you want to send me a question, you want to sign up for that seminar, you can go to bullingtoncapital.com. I'd be glad to try to answer questions during the radio show. We've done that quite a bit in the past. And I think it's going to be a great week. I like the way the economy is responding to a lot of things that are going on. That's good. GDP growth is actually near its highest levels that it's been in the last 9 years. That's a really good thing. Interest rates are relatively low. And by the way, when you have problems like you have with the Hurricane Irma, that's not an environment that interest rates are going to go up anytime real soon. You wouldn't be wanting to raise interest rates when your financial systems are under a little strain, because we know they're going to have some losses there, and it's going to take a little time to make some of that back. So they're not going to, that'll actually deter the Fed from raising interest rates anytime soon. So that risk is mitigated. We're also into the first week, actually just past the first week of the worst performing month out of the year historically. A lot of people think it's October. It's actually September. September is generally the worst performing month out of the 12 months. Lots of reasons for that, and some of them are actually going away, but and nothing is as constant as change. So we haven't had a huge correction. Stocks are not super overpriced. At least most of them are not. There's a very small pocket of really large companies that people recognize. They're overpriced, but not by a lot. It's not like they should be selling for half of what they're selling for. They're selling for 15, 20% more than they should be. Some cases a little bit more, but that's relatively a relatively small premium on those companies, which is one of the reasons I think it's really important right now. If you're thinking about investing, you may want to be including international emerging markets. Those are doing much better than ours have this year. The prior 5 years, they were a drag, a real big drag. So if you have exposure to that this year, you're actually pretty happy about that. And you should be. It's a good thing. Their economies are actually growing a lot faster than ours are, and the valuations on their stocks are a little bit lower. That's good. Valuation, for those of you that don't know, is just basically it's an estimate of it's what it's selling for, what a company is selling for relative to what it should be selling for. And it's an estimate. What's the valuation? Well, the valuation's either high or low, or it could be right around where it's supposed to be, I should say. And when stocks are selling ahead of where they should be, it can be not a good thing. That's part of what we're going to be talking about at the other part of the seminar. How do you know when stocks are overpriced? How do you know when stocks are overpriced? Now, that has nothing to do with timing, by the way. All that is doing is saying, okay, there's higher risk in stocks because they're overpriced right now. How do you know that? I'm going to give you a formula that's actually easier than the 10-minute retirement plan. Okay, and it's very effective. In fact, it's at least as effective as the discounting cash flow calculation that they teach in most of the CFA programs or in MBA programs or accounting programs. It's at least as effective as they are. You know why? Because I know what you can know, and I know what you can't know, and I know the difference. A lot of people that just memorize the formulas, they just know the formulas. That's it. This is how it's supposed to work. Well, yeah, until it doesn't. And I will show you what those things are, too. It's fun. It is fun. There are some companies out there right now that look pretty good. I'm going to stop. I won't talk about them until the last part of this program, because that's another whole part of the total picture. And it doesn't have a whole lot to do with what you should be doing with most of your money. Most of your money should be invested pretty conservatively. And the percentage that you have in the more aggressive stuff that you really are pushing the pedal to the metal is going to vary depending on your personality and what your goals are, how old you are, how much income you need to, all that stuff. Okay. But I think everybody should know a little bit about it, just enough to be able to tell the difference between some mutual fund manager that just got lucky and some mutual fund managers that have skill. Big difference. Lucky and skill. If you can tell that apart, if you just get that one thing for the rest of your life, that will have huge returns over the next 40 or 50 years, or 10 or 20 years. Yeah, hopefully even 5 years. At less than 5 years, luck goes an awful long way. So if you're like me, I don't trust luck. I would not want to just, I'm going to roll the dice. Yeah, I got a feeling. Yeah, I hate doing that because my feelings generally, I'm typically the only one that feels that way. And if you're the only one that feels that way, nobody's going to like your stocks and they're not going to go up. So I try to keep feeling out of it. I have a couch and a love seat in my office now, because when a client comes in and has a feeling, I'll recommend they go lay on the couch. If suddenly I'm starting to feel the same way, I'll go lay on the love seat. I'm just kidding. We've never had to do that. At least not when anybody was looking. But it is pretty funny. Ignore the feelings. Go with what you can know. Try to recognize what you can't know, and try to recognize the difference. That'll take you a long way. If you can figure out whether or not a stock is overpriced or not. That's what's funny about this radio program. People will call in and they're hoping that I'm going to say, "Oh yeah, that's an undervalued stock." That's it. And they don't know. And they don't know this simple formula. It's really easy. It's not hard to do. So, and if they did know, they wouldn't be calling in anyway. They'd be looking up the numbers. I'll give you an example. Like Hershey's chocolate. I love Hershey's. Hershey's chocolate is a really good company. The profit margins, their gross profit margin, that's before operating costs and taxes, all that, are 45%. That's pretty healthy. That's really healthy, actually. Their net after-tax margin over the last quarter was 12.24%. So they pay taxes. They're in the 40% bracket. Yeah, so they're actually, before taxes, their profit margin is closer to 20%. Wow. Who knew? Chocolate. And they had revenue, $7.5 billion. The market value of the company right now is almost $23 billion. It's 22.98, 23. And they had $7.5 billion in revenue. So I'm looking at Hershey's today, and although I really like the company, on a valuation standpoint, it's fully valued. Actually, it's slightly ahead of where it should be. Not a lot, a little bit. Actually, it's within 10 or 15% of where it should be. That's what I was talking about earlier on the show. If you knew how to do this calculation, which we're going to run through this on Thursday, I'm going to put it up on the board. I'm going to draw it for you. It's pretty easy to do. And you don't really need a whole lot of information on it either. And it'll give you a ballpark. And the ballpark is it's about 85% as good as the super sophisticated discounted cash flow analysis, okay? 85% of the time, you're going to come up with the same numbers that these guys that rack their brains and spend all their time working on this. And they get really upset, by the way, when I point that out. Oh, you do that in like 30 seconds if you know what you're doing. That's okay. That's okay. Yeah, it's one of the reasons I have a job. So anyway, although I like Hershey's a lot, right now the market cap, that's basically the value that the stock is selling for. Now they hear the music. We're going to have to wait. This is Bill Bullington. I'm right here on 1420. The answer, will come back to that question after these commercial messages. Me, that's who. I'm just kidding. Anyway, hey, this is the part of the show where we're going to talk about individual stocks. Many of you that have followed my programs or gone to the seminars in the past know that I manage a small fund, and I do about a third of the money using this particular strategy. It's a strategy, and it's not for everybody. In fact, I got to tell you, it's right up there with dieting as hard to do. Okay? Dieting is relatively simple too. You exercise more and eat a little less, right? That bottom line. The exercise more, eat less, you'll lose some weight. How much you weigh is going to depend a lot on you. Okay, your metabolism, and that's luck. You can't control that. You can't control your metabolism. So and this is very similar, and I put the level of difficulty right up there with it because it's relatively simple if you let it be. But it's not easy. Simple and easy are two different things. So with that forewarning, this time of year, generally, market's not that strong. It's actually a pretty crappy time of year. And I'm looking at the number of stocks that are tradable by a mutual fund. There are a little over 3,000 of them. And I'm looking at how many stocks are in a short-term uptrend versus those that are in a downtrend. And right now, the short-term uptrend is slightly below the short-term downtrend. Not a lot. I mean, it's very close. And it's much stronger at this time of the year than it typically is. So that's a good sign. That's a really good sign. And when I go through some of my screens, some of my scans, I like the stocks that are coming up. The valuations are relatively low. They're pretty good companies. That's very encouraging to somebody that does this for a living. And the first one that comes up on one of my scans is Navistar, which has scared everybody. Navistar, the big truck manufacturer, the one that got delisted a few years ago because they'd purchased so many little companies and tried to pull them together that they couldn't produce a cohesive financial statement. Imagine that. I remember when that all started happening, and I actually had an intern that worked for one of the accounting companies that was in charge of trying to put all that together. And very interesting. So anyway, Navistar comes up, and it's got a classic-looking breakout pattern. So if you're looking for a breakout pattern, that's a classic-looking breakout pattern. Navistar's symbol is NAV. And if I have some available money, I'll probably start to. I'll just pick up a few shares of that. So I have to see. I don't even know. It depends on if I got stopped out on something on Friday after I left the office. I have orders in. They automatically get executed if I'm not there. If a price drops below a certain level, and actually I use them to buy stuff too. I use a buy stop order as well as a sell stop order. So. That one looks good. And those of you that have listened to the show or have been in the seminar know that when you do this type of thing, it's that one of the reasons that it's so difficult is if something were to drop by, say, 10% or so from my purchase price, I generally will sell it. I'm going to cut my loss quickly because it came up on this scan for a reason. The stock is moving very quickly right now. If it starts going down very quickly, it's time to go. Because you have no idea just how far that stock may actually go. So that's why I said it's simple, but it's not easy. Because in a less than strong environment in the market, you're probably going to get stopped out on more transactions than you do those that win. So it's incredibly important to keep those losses as small as possible. And you still have to diversify. And so we'll talk a little bit about that at the workshop. But we're going to focus more on the fundamental side. Like Navistar has a price to sales ratio of 0.41. That's relatively low. That's relatively low. Even for the industry that they're in. That's relatively low. Okay. So I go to the next one. Comes up on this particular scan, and it's Cons. It's a CONN''S Incorporated. It's a retail store. Another classic breakout pattern. Doesn't look like quite like the Navistar, but its price to sales ratio is 0.43. Average for that industry is from 1 to 1.5 in a good expanding market. So at 0.43, that looks interesting. Stock's $23, which makes it even more interesting. I know a lot of people that start off from the beginning, they want to buy a $1 stock and watch it go to 20. Me too. I'd like to win the lottery too. And I'd like to see the Browns go undefeated at holding all the other teams scoreless all year long. That's the kind of thing that you're up against when you're looking at that sort of thing. Anyway, we'll come back to that later. So look at those. That's interesting. Lumber Liquidators, I talked about that when it first came up. And I bought it the day after. It was at $33.43 when it closed the day before that at 24. Yep, that stock jumped. And I'm one of the fools running in and buying it after the fact. Okay. So now the stock's up about 21% from where I bought it. So now you know why I do that. And if I'm up 20% now and my initial risk was 10%, I'm 2-1 ahead. And that's a pretty neat thing. By the way, this is not gambling at all. This is not gambling. Anytime you invest, you're risking money. So this is actually controlling the risk. That's what we're doing. We're being prudent. We're controlling the risk on this. Is this more aggressive? It's considered to be more aggressive than other forms of investing, mainly because the people that do it generally don't stick to the rules. And they'll buy a lumber liquidators, and they won't use a sell stop to cut their losses or to even take profits. And then when the stock drops 50%, like all stocks do at some point in time, all stocks go down 50% or more. They all do. None of them do not do that. Okay, so you have that sort of thing. That could be a really big problem if you're not really good at picking underpriced stocks that even if they were to drop down 50%, you'd say, well, look, I think I would like to buy more of that. Okay, so it's a different mindset. And you have different mindset. There are different styles of investing. Lots of people have been successful both ways. Warren Buffett's probably the most famous value investor. He doesn't look at stock charts at all. Nothing. Nada. Peter Lynch looked at him a little bit. Peter Lynch has the best track record of any mutual fund manager that's lived. Okay, mutual fund, not fund in general, because there are some hedge fund managers that have better long-term track records, but that was a different animal altogether. So anyway, he looked a little bit at charts. And there are some people like Richard Dreyfuss, the Dreyfuss funds. You may have heard of them. Okay. He was a chartist. The guy barely graduated college. His dad, he was from a wealthy family. His dad paid a brokerage firm his salary so he could have a desk and he could get him out of the house. Think about that for a second. And this guy turns out to be one of the better investors that's ever lived. And it's hilarious. And he used techniques very similar to the technique that we're using here to identify these stocks. So different strokes, different folks. And it's all about doing what is suitable for you. And I'll show you this stuff. Now, here's one I think is really interesting. Tempur-Pedic, TPX. You've all heard the Tempur-Pedic mattresses. I remember when that stock, man, back in the day, that thing really ran. I think in the 2005, if you adjust it for splits, it sold for as low as $9.41, and it got up to $37 in just a little over a year. Okay, that's 400%. That's a lot, especially in such a short time period. Then over the next 2 years, it bottoms out in March of 2009, goes all the way down to $4.96. $4.96. And then turns around the next 2 to 3 years, it's on a rampage, gets all the way up to $80. Can you imagine that? And today it's actually, and then it crashed again, goes down to 20. Now it's right around 62. The valuation on it's pretty good. It's only 1.15. That's not bad for that type of business. And it's running again. That's cool. So I'll probably take a shot at that one too. It's not going to be a big position. If I get stopped out of this, it's going to cost me less than 0.35% of my portfolio. I can do that all day. That's by the way, that's one of the keys to being a good investor is trying to minimize your losses. You want to minimize. You don't want to be a gambler. Do not want to gamble. You have to take risk, but you want to control the risk. So we're going to have all this stuff we'll be talking about at the workshop on Thursday. You can go to my website, bullingtoncapital.com, and sign up online, bullingtoncapital.com. It's free. There's no cost to attend. And I'm going to cover all this, and I always hang around afterwards to answer any questions that you might have. So you get a chance to see the 10-minute retirement plan, how to use that, some of the other tools that are available through clients of Bullington Capital. We get to see how to pick stocks that may be undervalued. And I have Discover Financial Services that's undervalued specifically from where I bought it. And it was $70 just a few months ago. Now it's at 57. I can tell you why, and I think that's a good one. But I would not trade that stock. It hasn't come up on the trading scan, so it hasn't met that criteria. So we'll cover all this stuff, and I'll hang around and, like I said, answer questions for you. They do a great job. Tri-Cities Corporate College, by the way, it's one of the best meeting facilities in Northeast Ohio. So with that, I'm going to let you go. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.